Hello, I'm your mortgage lender, Rob, and welcome to 10 Minute Tuesday. This is a live and recorded video I host every few weeks where I'll be sharing real estate and mortgage news, tips, hacks, and updates in 10 minutes or less. If you're not on my email list and want to be notified of future live streams and recordings, sign up at my website, link in the description. You can find it at mortgagebyrob.com. So there's Q&A at the end for anyone attending live. So if you're catching the replay and you want to ask live questions, join the next one. Drop your questions in the chat now or whenever, or when at the end, I will give you the option to unmute yourself and ask your questions. So let's get started. The topic today is the Family Opportunity Mortgage. We'll talk about that in a moment. First up, a quick rate update. We always do this real fast, so here's just a quick snapshot. Not going to be what you're guaranteed to get. This is kind of where market rates are right now. Conventional rates at about 7.25%. Government rates at about 6.625%. Now, this is slightly down in the last 2 weeks, though we've seen rates go up quite a bit in the last 8 weeks, really the last year and a half in total, but over the last couple months, more than we had seen in a short period of time. And right now, rates are still in a gentle upward trend, and that's due to a somewhat stubbornly strong labor market. However, today, as I'm recording this, the JOLTS data, the job openings, whatever it stands for, came back a little bit low. So that suggested a little bit softening in the market. So maybe rates hold for a little bit. We don't know. The likelihood of a Fed rate hike coming in the future remains still strong. So my thought is that rates are not done rising, although it might be slower. So we'll see. This week brings a lot of economic data. So that's that. On to the topic of today, Family Opportunity Mortgage. What is it? This is a conventional loan product. So it's a standard regular loan, which gives you a lot of benefits. We're going to talk about how this works and what exactly it is. So quick definition. So a family opportunity mortgage is when you are buying a home for a qualified family member using a conventional home loan, but you as the buyer or whoever the buyer is will not live in the home yourself. Now, why is this distinction important and why is this program important? Because when you buy a house owner occupied, you get some key benefits that you wouldn't have if you were not going to live in the property, such as a vacation home or an investment property. First one is you have a lower down payment. You have the option to put a lower down payment if you're going to live in the house. Conventional loans allow you to go as low as 3% down. Now we're using a $500,000 example. So 3% down versus a 20% down payment in the case of an investment property, which you can go lower, but 20% is an example, which is what most people do. So, I mean, the difference of 3% to 20% is $85,000 out-of-pocket difference as at $500,000. So that's a big difference in savings as just upfront cash. So benefit there. Usually you always get a better interest rate if you're buying a house to live in it versus an investment property. So this is, again, a rough estimate, but typically, you can see rates 0.5% to 1% in rate cheaper. Again, at the $500,000 mark, you're looking at saving $150 a month if you're financing the same amount. This is not a perfect example, but we're just giving you illustrations here. And then finally, on a owner-occupied property, you get lower fees or points. Typically, you're seeing people pay about 0.5 to 0 points on an owner-occupied home. If you're buying a property as an investment, you could expect to pay, or a vacation home, 1 to 2, maybe even 2.5 or 3 points, depending on where the market is right now. So that right there saves you thousands. And I've got $2,000 to $6,000 as an example in this case, but it could be more. It just depends. So big benefits buying a house when it's owner occupied. But the scenario here is we're talking about you have a family member who wants to buy a house to live in. They can't do it for some reason. You want to buy a house for them, but you don't want to buy it as an investment. So that's what the point of this is and why I'm bringing this up. So who can use this program? How can it be used? So children can do this to provide housing for their parent or parents. So the situation is if a parent is unable to work or does not have sufficient income to qualify for a mortgage, the child is considered the owner occupant. So what this means is if your parent can't afford to pay for their own home, and really a signed letter from them stating I don't have the assets or the income to do this is really sufficient. If they can't afford to buy their own house, you as a child can buy a house. It's treated as an owner-occupied purchase, but you are not expected to live in the home. You just get all the benefits of owner-occupied purchasing because you have a family member, a parent, specifically has to be a parent, who is going to live in the house instead of you. So it gets you all those benefits. The other scenario is if you are a parent and you have a disabled or a handicapped adult child, you can essentially do the same thing. Now, they have to be disabled or handicapped, permanent disability. Same thing if they don't work, they don't have income, they can't afford to buy a house. You as the parent can buy a house for them, again, getting all those same owner-occupied benefits without you actually having to live in the home as long as your child moves into the house. So a huge benefit. I have done this in person, or I have directly used this loan program. It's a fantastic way to help family who needs it if you have the means for it. Some important notes about this program. Now, the buyer, you as the person buying the house, not the parent-child, you must qualify for the house you're buying plus your current residence. So if you're renting your home or if you own a house already, then you have to qualify for the new mortgage on top of your existing one. So that you have to have sufficient income for that. And I can go over those scenarios with you, or if you have a client, somebody who is interested in doing this. If you are renting and you buy a house for a qualified family member, you are still considered a first-time home buyer in the mortgage definition sense. A first-time home buyer is someone who has not owned a primary residence in the past 3 years. And since this property, as long as you don't move into it, will not become your primary residence, you are still considered a first-time home buyer and can take advantage of other programs that would be open to first-time home buyers only, which most programs are open to everybody, but there are a few that are first-time home buyer specific. And then I guess I already put that here. Oh, and yeah, I got them all. Said that third one without putting the bullet up here. Yeah, and if you're renting, so you can still buy your own primary residence. I skipped over those bullet points, but if you buy this for somebody else and you're renting, you can still buy your own house as a primary residence. No issue buying one that was qualified as a primary residence. So the point is, doing this is not a one and done thing. You can buy for a family member and still use your own first-time home buyer primary residence purchase for yourself. That's everything. Let me check the chat. I don't see any questions. So thank you for attending, and make it a great rest of your day and rest of your week.